Hi friends, today let's discuss about the topic of how to save tax on capital gains. Before moving into the topic, let's understand what we are going to discuss in today's video. First, we'll be understanding about what is a capital asset. Second, we'll be discussing about what is a capital gain and different types of capital gains. Third, we'll be discussing about different types of tax rates applicable on each type of capital gain. And finally, we'll be discussing about how to save tax on capital gains. First, let's understand what is a capital asset. So, capital asset is any property or asset which is held for investment or personal purpose. So, this can be your house, your land, your jewelry, your shares, debentures, equity investments, etc. However, if any house property is held by a real estate company, it will not be treated as a capital asset since their business is building and selling the house properties. So it will be treated as stock in trade and not a capital asset for the real estate company. So for any capital asset, it is very important to understand the classification of such capital asset into long term or short term to understand the tax applicable on capital gains arising from such capital asset. So now let's understand depending on the holding period which category of asset will be classified into long term or short term. The first category is listed equity shares and equity mutual funds. So if these assets are held for less than or equal to 12 months, they will be treated as short term capital assets, and if they are held for more than 12 months, they will be classified as long term capital asset. So the second category is immovable properties like land and building and unlisted shares. So if these assets are held for less than or equal to 24 months, they will be treated as short-term capital asset, and if they are held for more than 24 months, they will be treated as long-term capital asset. And the third category is debt mutual funds which are acquired before 1st April 2023 and your gold jewelry, physical gold jewelry. So these will be classified as short-term capital asset if they are held for less than or equal to 36 months, and if they are held for more than 36 months, they will be treated as long-term capital asset. So gold jewelry like gold and silver ETFs which are traded in stock market will be treated as will be considered in the first category. So with respect to debt mutual funds, if they are acquired after 1st April 2023, they will be treated as short-term capital asset irrespective of the period of holding. So once we understand the classification of capital asset, let's understand the topic called capital gains. So in simple terms, capital gain is any profit which you make by selling any capital asset. So if any capital gain is arising from transfer or sale of short-term capital asset, it will be treated as short-term capital gain, and if any profit is arising from sale or transfer of a long-term capital asset, that will be treated as a long-term capital gain. So now let's understand the taxability of capital gain depending on the nature of the capital gain. So if it is a short-term capital gain arising from sale of listed equity shares or sale of equity mutual funds, that arising short-term capital gain will be taxed at a flat rate of 20%. And if any other short-term capital gain will be taxed, will be added to your taxable income and will be taxed as part of your applicable slab rate. Coming to long-term capital gains, if any long-term capital gain is arising from sale of equity shares or equity mutual funds, any gain which is over and above 1.25 lakhs will be taxed at a rate of 12.5%. So that means if your profit is only up to 1.25 lakhs, you need not pay any capital gain tax on such profit. Only if your profit is exceeding 1.25 lakhs, then you will be required to pay a tax of 12.5% on such excess amount. Any other profit arising from transfer of any other long-term capital asset, it will be taxed at a flat rate of 12.5%. So let's discuss about the main topic of our video, how to save tax on capital gains. In income tax, we have multiple ways to save tax on different types of income. So with respect to capital gains, let's discuss about two important sections which are relevant for everyone. So first let's discuss about section 54. As per section 54, if you are having any capital gain on account of sale of long-term house property, the capital gain tax will be exempted if you invest that amount for purchasing a new house property. So the time limit for purchasing a new house property is within 2 years from the date of transfer of the house property, and if you want to construct a new house property, the construction should be completed within 3 years from the date of transfer of the house property. You can also avail the exemption for the purchase which you have done before the sale or transfer. However, the purchase should have happened within 1 year before the date of transfer of the house property. So the maximum exemption which you can avail here is rupees 10 crores. So if there is any gain on account of sale of house property of 12 crores, you can claim the exemption only up to 10 crores. Also, if the capital gain is less than 2 crores, you can use that amount for purchasing two different house properties. So that means if you are having a capital gain of around 1.5 crores, you can buy two new house properties and claim the entire 1.5 crores as an exemption if you have used the entire amount for purchasing the two different house properties. However, this option can be used only once in lifetime. So if you have already used this benefit of claiming exemption for two different house property, you cannot claim it in future. Now let's move to section 54F. In section 54, we had exemption from capital gain only if it was arising from a transfer of house property. But most of us may not be having capital gain from sale of house properties, but we might be having capital gain from sale of other assets like equity shares, bonds, debentures, gold jewelry, or your plots, land, etc. So if you are having any long-term capital gain from sale of assets other than a house property, that amount will be exempted from capital gain tax if you use that amount for purchasing a new house property. So here also you get the exemption only if you reinvest that amount into a house property, and the time limit is same as per section 54. So you should complete the purchase within 2 years or complete the construction within 3 years. The maximum exemption which you can avail in this section is also section rupees 10 crores. So however, there is a condition which is linked to section 54F. So you should not own more than one house property on the date of transfer of such capital asset. So suppose if you are having two house properties on the date of selling your shares, you cannot get this exemption. And if you are having only one house property, you can use that capital gains for purchasing a new house property and avail the exemption. And also you should not purchase a new house property or construct a new house property within 2 years and 3 years respectively. So let's understand both the sections with an example. So first, section 64F. Suppose Mr. A has purchased a house for rupees 80 lakhs in 2020 and sold it for 1.2 crores in 2023. So, and also he invested that entire amount to purchase two new house properties which was 60 lakhs each. So now here in the first transaction he had a capital gain of 40 lakhs because he purchased it for 80 lakhs and sold it for 1.2 crores. So now let's understand whether it is a long-term house property or short-term house property. So as we first discussed in the starting of the video, we've discussed that any immovable property like house and buildings, land, etc. will be treated as long-term capital asset if they are held for more than 24 months. Since it is held for more than 24 months, like he purchased in 2020 and he sold in 2023, so it's been 3 years, more than 24 months. So this house property will be treated as a long-term capital gain and it will be exempted from tax under section 54. So since he has invested all the amount in for purchasing a new house property, he can claim the exemption and he need not pay any capital gain on that 40 lakhs of capital gain. Also here, since the capital gain is less than 2 crores, he can purchase two different house properties and claim the entire exemption which he had done already. So now let's move to section 54F. Suppose Mr. B has purchased shares of ABC company for rupees 50 lakhs in 2023 and he had sold it for rupees 80 lakhs in 2025, and he used that amount to purchase a new house property for rupees 80 lakhs. So here there is a capital gain of 30 lakhs on sale of shares. Since he has purchased for 50 lakhs and sold it for 80 lakhs, there is a capital gain of 30 lakhs. Let's understand whether it is a long-term or short-term capital gain. As we discussed earlier, any equity share which is held for more than 12 months will be treated as a long-term capital asset. So here, since he has held it for more than 12 months, it will be treated as a long-term capital gain, and it can be qualified for exemption. So now, since he used that amount for purchasing a new house property, he can claim the exemption on the entire capital gain of 30 lakhs, and he need not pay any additional tax. So continuing the example of section 54, both the houses which Mr. A has bought for 60 lakhs each are having a market value of around 1 crore. So there is an increase of 40 lakhs in the value. So Mr. A had thought that he wanted to sell both the house properties and purchase two different house properties, 1 crore each. But however, since Mr. A has already used the benefit of purchasing two house properties, he cannot use that benefit again in this current transaction. So he need to pay tax on the second house property, which is 40 lakhs capital gain, and tax will be payable at the rate of 12.5%, that is 5 lakh rupees. So in order to save this 5 lakh rupees, what he can do is he can gift the second house property to his child and get it registered through a gift deed and by paying the stamp duty. So any gift which is received from a relative is not taxable in the hands of the receiver. So the child need not pay any additional tax on the gift which he has received. So now Mr. A can sell the first house through his name and the second house can be sold through his child. So now both Mr. A and his child can claim the exemption of section 54, and they can save the tax on the 40 lakhs, which is around 5 lakh rupees of tax. So by this way, Mr. A can save the tax by using the section 54 of capital gains. If you like my content, please do like, share and subscribe my channel. Thank you.